a very interesting topic and most relevant topic for the month. Finalization of books of accounts from GST perspective. To enlighten us on this topic, we have invited eminent chartered accountant and expert in GST, and he has many new ideas, and he developed a software, a tool, not a software, maybe a tool to reconcile GST 2A or 1A. I am not an expert in that. I don't know, but he developed that, which is really useful, and an expert on the topic. CA Venugopal G is with us. On behalf of Bangalore branch and on behalf of all the participants, hearty welcome to Mr. Venugopal. Hearty welcome, Venu.
Thank you, sir. Thank you.
Yeah, our branch secretary Divya is there. Hearty welcome to Divya. Yeah, friends, you are the reason for this program. Your interest in GST, whenever we announce GST program, good number of people register and quickly attend that program. That shows the demand for GST program. That is the reason we arranged, and we thought it appropriate in this month. Many accounts we are going to finalize. At that time, better look into GST reconciliation and make it correct in GST point of view, including income tax. Income tax, majority of the people practice and they look into 26 AS. Now GST portal also connected with income tax. It is appropriate and most important to reconcile the GST issues along with the finalizing the balance sheet. Otherwise, later the client will face the problem from the department when it is not matched with the income tax turnover with your GST turnover. There is one area, and there may be many other issues also involved probably. And this month is the last month for whatever the mistakes or omissions of 2021 to correct it, if I am right. So that also I think can be looked into in this month while finalizing the accounts. Account needs to be finalized in this month for all the corporates. I believe the extension not yet come from ROC point of view. Hence, we thought it appropriate to have this session. So I'm sure those who all joined, also inform your friends to look into this so that our fraternity do the good job from compliance angle, both GST and income tax. That is again a duty of a chartered accountant as a partner in nation building. Look into all these aspects and advise clients if there is anything pending, so let them pay that to the department concerned. With that note, once again, hearty welcome to each one of you. I'll take a minute of yours to inform tomorrow 3 days workshop on information technology arranged from, it is going to start from tomorrow to 18th, Thursday to Saturday, 3 days program. Very interesting again, very important. Those who are interested in information technology, I request please register to that program. Also inform your friends and colleagues to register. It is again an important program. Things are changing. Information technology is the need of the hour. Either you or your junior partner needs to learn. One of the partner in the office needs to learn this IT. That is most important to do the audit, to do many other things efficiently, effectively, timely, quickly. All this IT going to help. I request to register for that program. It is going to start from tomorrow 4 to 7, 2 hours every day. Tomorrow it is going to be 3 hours. Tomorrow another interesting session along with this is new Tally Prime. The magic of new Tally Prime also going to be learned tomorrow for 1 hour along with this information technology. That is again a part of that. It is a 3 hours program tomorrow, and day after and Saturday it's going to be 2 hours, total 7 hours of learning, friends. Very important. I request all of you to register that. And again, many other programs also lined up for this month. Please visit bangaloreici.org to know and to whichever interesting to you to register that program. Please visit bangaloreici.org. With that note, once again, hearty welcome to each one of you. Over to Divya.
Thank you, Chairman. A very pleasant good evening to all the participants and to the speaker of today's program. I have CA Venugopal sir with us to give a brief introduction about him. His father and Mrs. Venu and Vinay Chartered Accountants, qualified in the year 2002, by securing All India 45th rank. He is also certified information system security auditor. He also completed various other certificate courses from ICI like visa, course on business valuation, courses on internal audit, fraud detection, and forensic accounting. He also completed 1 year course from IIM on data analysis and business intelligence. For this very brief introduction, I wholeheartedly welcome you to today's program, sir. Hearty welcome.
Yeah, thank you. Thank you, Divya, and thank you, Chairman Sir, for your kind words in introducing. And I'm very happy that this session has been taken at an apt time when members are finalizing their books of accounts for the clients for the year 2021. Let me just share the screen. Hope the screen is visible.
Yes, it is visible.
And members, feel free to interact. I know this is a one-way session, like a mono dialogue, and in a real sessions, we definitely have a lot of opportunities to interact. Consider this as like a one-on-one session. Put your questions in the chat, in the Q&A section. I will be taking up the questions as and when it comes up appropriately, so that we can discuss things at the same time. In a physical session, we can have that interaction and I can really get the pulse where the conversation is going. So it's very difficult for us, each one of us, to catch our attention and be in the session. All right. So let's begin the discussion on the finalization of accounts. And when we say finalization of accounts, what is more important for the finalization of accounts is it is getting is everything right? We say true and fair view. Like really, is everything right? When we say everything right, from the audit evidence or the accounting confirmation of balances to various things, when we say is everything right, we really mean that every aspects have been taken care or not. And I definitely don't need to advise or talk on the audit and other external confirmations, but I am restricting all my discussions today from the GST perspective. So today's focus is less on GST, more on when you are finalizing the accounts, what are the things that we need to look at from GST. More so, the activity of filing annual returns, which is GSTR 9 or 9C, though which happens in December after the finalization of accounts, I would personally feel that it is not an activity which starts after the finalization of accounts, but it might be before or at the time of finalization of accounts only, and it is not post. So that we are in control of all the data that we are presenting to various statutes. So the agenda for today's discussion is firstly on presentation. So the disclosure in the financial statements, again, those relating to the GST related aspects, what do we disclose, how do we disclose, both on the face of the financial statements, notes to accounts, and audit report. We look at that. Then as I finalize my turnover, what are the things I should look from the GST perspective and take an account of that and consider the finalization of the output, input tax credit, and liability thereon. Very crucial thing which I would want everyone to pay attention on, the adjustment entries one needs to post for the purpose of GST, which we can call it as an internal accounting control entries or a confirmation of balance control entries, which will give a satisfactory and corroborative evidence to the auditor before he finalizes the accounts. So to begin with, the presentation of GST related aspects in the financial statements. Friends, there are various items that pertains to GST in the financial statements. What are those various items and how do we present or how do we disclose in the audited financial statements? To begin with, the balances in various ledgers. What are the balances that are there in the various ledgers? First, input tax credit. Now, we all know when a purchase entry is made, I debit the expenditure. I debit GST input tax credit, maybe input GST, input IGST, CGST, different, maybe with the rate wise, depending on the type of accounts created. Credit vendor with full liability. Now, these input GST, which is there accumulated in these ledgers, should it be presented as such as on 31st March? There is multi practices. People might have one GST ledger. On the extreme hand, people have rate wise GST ledger segregating input output. So on the extreme hand, one GST ledger with input output everything to it. On the extreme right side, rate wise accumulated to it. Now, with these multi ledgers having balances, can I have these balances just like that accumulating month over month to the year, or should they be knocked off? Can I offset it? What should be the balance that should be reported as on 31st March in my input CGST ledger? For the obvious reason, we have filed GSTR 3B. To the extent GSTR 3B is filed, you cannot have any balance in input CGST SGST ledgers because technically you have offset that. So you have to reduce those balances. A doubt that might arise, as on 31st March, can I go ahead and knock off even the March input and output because I have already filed it on 20th April? The option, both way the options are permitted. I can knock it off or show the gross as such. However, it is only permitted to the extent where the balances representing where the 3B is not filed. Wherever 3B is filed, you necessarily have to knock it off and you cannot carry forward that as a balance because that balance technically doesn't exist. Okay. Now, having understood what is the value that needs to be reported, where it needs to be reported, it has to be reported under current assets because this is something which can be offset within the near future. So the unutilized portion of input tax credit will form part of other current assets. I would have paid GST under reverse charge mechanism. So the various entries under reverse charge I would have paid. Where do I report? Even that goes under same treatment of input tax credit, other current assets. Now sometimes the credits are not matching. Again, here we will find the clients with extreme cases. Some would say that, okay, I will avail the credits to the extent what is there in GSTR 2A. What is not there, I will not avail the credit. I will not get into a litigation. On the extreme hand, irrespective whether or not there is a line item in GSTR 2A, you would find some SSC, some taxpayers taking credit into GSTR 3B, whatever which is there in the books of accounts. Now, which is the right practice? Either of it is a practice, but however, the choice the auditor has to do while finalizing the accounts. So we are now specifically talking about those credits which is there in the books of accounts, not there in 2A. Should auditor qualify report the answer to it? It is a choice of the SSC. He would want to fight for the case, so the option would be left to him. Now, that means it would be lying as an input tax credit. So what are the multiple activities or multiple versions people do? Broadly, there are 3 different methods I have noticed in accounting. First and foremost, people, those who are not availing input tax credit, or they would want to withhold the payment when the credit is not available, they debit back. So they take it back from the input tax credit ledger and offset with the vendor with a statement saying that wherever it is not visible, we will not be making payment to you. Or there's one set of SSCs you will find, okay, I am not going to avail this credit. I am not placing the party, I will charge it off to expenditure. There's a other set of people who will say, I will carve out from my input CGST, SGST ledger, park it into a separate entries, a separate ledger in other current assets itself. Whenever I get the credit available, I will record this. Now, people found various ways of automating this in their books of accounts. It's not that one will be doing manually. So today we have tools to aid to automate the accounting entries. And I'm sure by now most of you have well versed with the kind of RPA and other tools that are available, which are aiding the taxpayers in doing these automations. All right, so I have handled the input tax credits wherever which is not mismatched. What else the input tax credit could be? There's an input tax credit I have paid along with the customs duty whenever I have made imports. Now, thankfully, even this information is available in GSTR 2A. So, even this is a credit. So, in earlier regime, if we have to say, these are SEN-vatable. So, this is ITC eligible. So, even the input IGST paid on imports is an eligible credit. You will be carrying it under other current assets to the extent it is not availed. Balance is the last item. Everything is there, but it is an ineligible input tax credit. Either you have reported in 4B of GSTR 3B, or it would have been reported in 4D of GSTR 3B. Where do I group it? This is obviously debited back to the P&L because it is not an eligible credit. There are two ways. Whenever you debit back to P&L, there are two ways of accounting and adjusting. Either you debit it to the natural head of account, or most commonly adopted route is debited to rates and taxes. I would personally feel that the accounting to the natural head of account, for example, I have provided staff welfare. There is some food expenses incurred, or I have the cab services availed from Ola, Uber, whatever, for my staff to travel to the client's place, etc., or any of the credits where it is not eligible. In such a scenario, the ineligible input tax credit should be added back to the expenditure head in which it is incurred. Maybe traveling and conveyance, maybe staff welfare, whatever it is. But while recording the original entry, you should record, or you should advise to record along with the GST separately and reverse the GST. Why should I record along with the GST when it is not eligible? It is required because you can carve out and see and match the line items of GST or 2A. Otherwise, it will show up that, okay, these are entries which are there in 2A but not there in the books. Then it adds to another reconciliation. But it has to be charged off to the P&L, and recommended practice is to charge to the natural head. The last item in the input tax credit, in an ineligible credit, is a credit which is not eligible on account of common exempted output. Common credits used for an exempted output, commonly which is rent, audit fees, etc., advertisement, etc., which is commonly used. These credits are reversed in proportion to exempted turnover in the basis by virtue of Rule 42. Now, whatever the computation that you have done in Rule 42, even this quantum that is reversed can be attributed back to the natural head. You know, the exempted turnover is 40%. Common credits, let's say audit fees or security charges, rent, advertisement, so much. 40% of the input tax credits in these is not eligible. So you just charge off 40% back to those respective heads. You may pool your common credit to be reversed and park it into a ledger. From that ledger, and it can be apportioned back to the natural head of accounts. So as an auditor, we have to advise the client that they find a mechanism to record and offset the accounting entries whenever there is an ineligible credit. With this, we have seen how do we treat the balances that are representing in input tax credit as on the balance sheet date. Next comes cash balance. When I say cash balance, balance in electronic cash ledger, or sometimes I would have paid GST on advance. Both these balances, definitely not cash and cash equivalents. Even though the monies available in these ledgers can be drawn any given point of time by filing a refund application, so that balance is not a tax payment. Balance in the cash ledgers are not tax payment. Even though it's a not tax payment, it still has to be treated as other current assets and not a cash and cash equivalents. Next, output liability. The output tax payable, which is lying in the books of accounts. These output liability forms part of other current liability. This forms part of other current liabilities. Before I move on to the next thing, let me see if you have any questions so far. You can put your questions in the Q&A. I will take up those questions at the respective time. Moving to the other aspects on presentation is whenever I file a refund application. When a refund of GST is filed, we all know the moment I apply for a refund, whether from my credit ledger or cash ledger, it's kind of a suspense entry would be created. So the amount would be parked from my electronic credit ledger and it is parked outside where for the officer to process it. And so, which means technically it is transferred from the ITC or cash ledger to some other ledger. So it has to be treated as another current asset. Even when a refund is allowed, you got a RFD and it's allowed, still you receive the money, it will be other current assets. Whenever a refund is disallowed, to the extent money is transferred back to your credit ledger, it is definitely an input tax credit, so backs to other current assets. But sometimes it is disallowed, stating that this is an ineligible input tax credit one has claimed. So the officer would say ineligible, and accordingly a demand order would also be raised. So if you feel that yes, it is ineligible, it has appropriately to transfer it, it would become to an expense or to the rates and taxes. Now the next very important thing is the notice. There is, by the way, there is a difference between a statement notice, show cause notice, demand order, pre-consultation notice, DRC01A. So different types of forms, documents which we receive from the department. From the client perspective, anything that comes from the department is a notice. Whether it is notice or show cause notice or an order, it is a notice. But from the audit perspective, how do we treat with them? Whenever you get an intimation under ASMT 10 stating there is discrepancy between GSTR 1 and 3B, the liability you disclosed in 1 versus 3B, there is a difference. You need to make a payment. So you might get some notices, intimation in that format. Or the credit that you have availed in GSTR 3B is higher than what is there in 2A. Now, whenever a notice of this sort has come, should you as an auditor, while finalizing, make a provision in the books of accounts? Point number 1, do you need to make a provision? Point number 2 is, along with the provision, if the provision is not done, should you make a notes mention to it of it in the notes? In either of it, I would say no. It is optional at the choice of the taxpayer. If he chooses, he would do. Otherwise, it is not required. Both for an ASMT or a show cause notice, it doesn't warrant either a mention in the notes of accounts or a provision in the books. But the last one, which is an order, which is a demand order. So you got DRC 07, confirming some liability to be paid. Now, in such a situations, necessarily you need to make a provision if there is no appeal for the same is done. So, even when there is a demand order, should it be provided? The answer is not affirmative. However, there shall be mentioned to the notes to accounts that so much of the demand has come, and there is a specific mention to it in the CARO also. These are the presentations requirement which are there in the balance sheet level. These are the balance sheet level presentation. However, when it comes to the P&L side presentation on the turnover and expenditure, unlike the excise duty, we don't do a gross up of the duties along with the turnover. So the GST collected on sales will be shown as a liability. So the turnover is always shown net. Second, the revenue recognition as per accounting standard 9 or the Ind AS versus the time of supply as per section 12 and 13 read with section 31 could be a different under GST. Do we need to give this indication in it? No need to have a separate mention, even though the revenues are not matching, there are reconciliation items. There's no requirement to explain about why there is a difference between the books revenue and the GST revenue. Lastly, on contingent liabilities, which are pending disputes not acknowledged as the debt, definitely wherever there are pending disputes that would be reported by the client. So those are the liabilities which are not acknowledged as a debt would be reported in under contingent liability section. Broadly, these are the reporting aspects. These are the reporting aspects for the GST related items in the balance sheet. Any doubts to anyone so far? Let's move on to the next aspect, which is reporting under CARO. CARO has two aspects for reporting. Whenever there is an undisputed liability. Undisputed liability means I have acknowledged there is a liability, but I have not paid. Then there's a second category. There is a liability, but it is disputed. So department is saying it has to be paid. I am saying it is not required to be paid. How do we report it and how do we present? Let's first understand on undisputed liability. What does the undisputed liability will include? All statutory dues. All statutory dues. Most importantly, those dues which are outstanding for a more than 6 months. Outstanding more than 6 months on the last day of the financial year is what we are reporting. There are two common mistakes that happen. Let's say January 21, GST liability is not paid. Jan 21 GST liability is not paid. Not paid when? Not paid, say, as on date. Does it cross the 6 months? The answer is no. Today, if I say September Jan liability, between Jan to now, yes, it crossed 6 months. But as on 31st March, did it cross 6 months? The answer is no. So it need not be reported. What's the second mistake that happens? I have liability, say, April to March. Post amnesty scheme, one has reported and paid all the taxes. Returns are filed. They have been filed as on the date of signing. It has been filed. Should they be reported? Again, many people ignore them, saying that okay, anyhow it has been paid, so nothing is outstanding. In both the cases, it is wrong. Thinking that it is payable as on signing date and to be reported, or thinking that it is not pending, everything has been paid as on the signing date. So both are wrong. We should look at as on 31st March. If anything more than 6 months is due, you have to report it. What are all the things you will consider? You will consider everything. Everything. The tax, interest, late fee, tax, interest, penalty, and everything you will consider. And what is your scope? You will have to report whether the duties applicable to the companies have been paid and the regularity of it pending, is like how frequently they are paid and whether they are long pending. This is what we are going to comment. Now, the only contention or only point of dispute, is at what point is this 6 months I have to consider. Should I keep 30th September as cutoff? So liabilities from 1st October I will ignore, and liabilities prior to 30th September I will consider, or what is this 6 months date? If you notice, there are two schools of thought. One is obvious, whatever the liabilities up to September, definitely they are more than 6 months. If it is not paid as on the balance sheet date, you will report it. There's another school which will say that no, September also you can exclude, because 30th September liability is due for payment on 20th October. Hence, that needs to be reported in 20th October. From 20th October, 6 months did not elapse, so you can ignore the September and take it from August. Whatever it is, have a consistent policy. And this, as I said, you will be applying for tax, GST fully, interest, penalty, late fees, other fines, everything. This you have to include. You have to include everything as on the balance sheet date. Now, this report will be restricted to actual arrears because this is undisputed. So client also agrees that this is the liability to be paid. While finalizing this, you would necessarily have to obtain a management representation letter, because what we are talking is undisputed. There are so many cases we've been hearing about GST. Rate of tax is like, again, classic. If we have to make fun of GST, on WhatsApp, people have heard that masala papad, which is in square shape, is taxable. Papad, which is in round shape, is exempt. But actually, it was not about papad. It was about the item. So, like items like kurkure or something pre-packed papad materials, they are definitely taxable. But media always finds. Even we had this buttermilk is exempt, but flavored milk is taxable, right? So now, why is that relevant to us? Now, we never know what is the HSN classification adopted by the SSC. Most of them have adopted, say, 5%, 12%, 18%. Sometimes would have been paid higher, some would have been paid lower. We are going by what is there in the books of accounts. We are not an experts on HSN classification. So we go by the turnover that is reported, rate of tax on the turnover, exemption classification, all these are valid. So that 6 months cutoff, so the SSC did not make an adjustment. We are looking at a full period, but he did not make an adjustment in books such a way that less than 6 months is a huge numbers and more than 6 months is hardly any number, and saying that everything is paid. We are going mainly from the books of accounts, and we are just taking as such whatever is there in the books of accounts. So it is very much important you obtain a management representation letter before you actually go ahead and take up that, okay, fine, this is what we need to report. Now let's look at what and how we have to report. I said two things we have to comment. One is the regularity of the payment. So regularity of the payment is only one simple English sentence, but you have to put yourself into any of the following positions. You are happy and satisfied. You're partially satisfied. You're not satisfied, or partially not satisfied. Satisfied, not satisfied, I completely understand. No, but partially satisfied, partially not satisfied, this sounds like dharma sankata. It's like where do I find myself? And again, audit is all about subjectivity. It is the call of the auditor. Let's look at what are we trying to comment. When there is a satisfied, that means the client is regular in depositing the dues with the GST authorities at the appropriate times, appropriate periods. Client is regular in depositing. when we say partially satisfied, it means I'm not fully satisfied, but yes, I'm satisfied, but partially satisfied. Then I use this word called slightly delay in few cases. Again, there is a difference between some and a few. In internal audits, it is the words in the audit report matters a lot. If your observations like 1 out of 100, 2 out of 100, it is like a few instances. When we use some instances, it means like 10 out of 100, 20 out of 100, right? So that is where you will bring in this partially satisfied and partially not satisfied, right? So when you feel that it is partially not satisfied, you will now use a negative adjective that you are not, the SSE is, the client is not generally regular in depositing the taxes with the appropriate authorities. Though there are delays, but it is not serious. So there are delays, but it is not serious. When you are not satisfied, then you will say that there are delays, considerable delays in a large number of cases. Now, here where again your subjectivity would come in. 2 months I have delayed for roughly say 30 days, right? Now, will I say partially not satisfied or not satisfied? Versus all the months I have delayed by 1 day or 2 days. 12 months I have delayed by 1 day or 2 days, which means I have totally delayed say 12 days. Versus we are talking about 2 months, 30 days delay. Rest of the period, rest of the months I have deposited much ahead, much in advance. Now here where the subjectivity comes in, so auditor has to definitely take an appropriate call by himself. And the words in the audit report are very critical. During the peer review and everything, this is what is going to check your documentation for your audit standards, the appropriate documentations for the audit standards. It is presumed that the accounting standards are there in the back of mind. It is the duty of the client to comply with the accounting standards. Our duty is to comply with the audit standards. So documentation is looked from not accounting standard perspective, but from the audit standard perspective. Okay. Now, having reported that these are the delays and this is what the payment regularity, then there is a second thing that if something is beyond 6 months, as on the 31st March, I have to report. How do I report that? I report whatever is the statute, which is GST, what is the nature of due, which is whether interest, penalty, late fees, whatever it is, how much is the amount, what is the period to which it relates to, April 20, May 20, whatever is the respective period. When was it originally due? And when did it paid? So please note, even though if it is paid after the balance sheet date, if April has been paid, let's say in Jan and Feb, nothing is outstanding as on the balance sheet date, we are not reporting. If something is paid after the balance sheet date, then you also mention the payment date. So the due date and the date of payment is also to be mentioned in the audit report. This is one common area people miss out in doing the appropriate reporting. Moving on to the second one, which is dispute and undisputed, right? So whenever something which is there is a dispute that has arisen from the department side and the SSE feels that there is no dispute. Now what is the dispute? Is the 2A credits are less and you have availed more, or there is GSTR1 value higher than the value reported in 3B. It could be various things. Now assess the dispute first. Assess the dispute first. Whether it is merely an ASMT intimation, ASMT 10, because between section 59 to section 64, the assessment provisions under GST are only assessment. Mere assessment is not a demand. There shall be a demand separately. So any demand, again, the adjudication process under GST from 60, like from either from your provisional assessment or any of the assessments, deemed best judgment assessment, the adjudication process has to start and move to a notice under section 73 and 74. From the notice under 73, 74, it has to go to a demand. So there is a process. So mere a document which is found on record stating that there is a liability doesn't call for it. So first you assess whether it is a demand. Only demand creates a dispute, right? So if there is no demand, you will not be reporting. Only if it is a demand, you will be reporting. That is a point number one. Point number two, providing for it in the books of accounts doesn't make any difference. Whether or not it is provided, it has to be reported by the auditor, right? The last thing, where you can ignore it, like where you cannot ignore it. Now, sometimes there is an appeal that needs to be filed. Again, appeal to appellate authority. Where is it? Is it like there's a tribunal or the commissioner or the high court? You know, with the tribunal or the high courts, we have this Supreme Court judgment where, okay, there is an extension of the time limit. But I have a lower refund received and something is ineligible, something is disallowed. I have to necessarily go with the commissioner appeals and the 3 months time limit is there. So I have exhausted, I did not act anything on it. Definitely that is a confirmed demand and it has from disputed liability, it is shifting to undisputed liability. Here is where the judgment has to come in and necessary representations have to be taken by the auditor before finalizing these numbers. Now, after considering what are all the undisputed demands, what is that I should be considering is firstly on the provision. I said whether or not it is provided, whether the provision exists, provision doesn't exist, the reporting remains the same. So what is the reporting? What is the statute? Nature of the due amount, the period for which it relates to, which financial year this dispute is there, and in which forum this dispute is pending. Is this pending with the tribunal or whatever, which is the forum it is pending, and remarks if any. This is what we will be reporting under CARO. So we have seen reporting under financial statements, we have seen reporting under CARO. So any doubts to anyone, we will, before we move to the next part of the discussion. On assessment and finalization of those numbers. So we have seen whatever the numbers that are there, how those numbers have to be reported, we have seen. Now, how to assess the correctness of those numbers, let us move on. The first point is praising upon my turnover in the books of accounts vis-a-vis turnover in the GST. Now, we all know the turnover when I talk in the books of accounts, it only resides in the credit side of the P&L. The turnover in the books of accounts resides in the credit side of the P&L. But when it comes to the GST, the turnover in GST will be all around. It could be anywhere in the books of accounts. Here where the auditors first, the judgment and assessment is very important. Before I finalize my turnover, I should also finalize the GST turnover and do a reconciliation. And where can I find my GST turnover? Everywhere in the financial statements. Credit side of the P&L, debit side of the P&L, asset side of the balance sheet, liability side of the balance sheet. Sometimes outside my financial statements also the GST turnover will be there. So let's look at simple examples just to get a fair understanding about it. And these values will change business to business. These values will change business to business. The line items would be changing. Credit side of P&L is obvious. Everyone knows. So let's not much dig deeper into it. In fact, I'll come. What are the exclusions from the credit side in the slides to come? Let's look at other aspects. Debit side of the P&L. In the debit side of the P&L, what is that we will find? if as an auditor, I have a practice of recovering my out-of-pocket expenses, the travel which I have incurred towards the audit, my stay and food expenditure which I have incurred during the course of the audit. While raising an invoice, I have raised invoice for professional fees, invoice for out-of-pocket expenditure. But when out-of-pocket expenditure is collected, I have credited to the expenditure heads. I have credited to the expenditure head. My traveling and conveyance got shrinked. My staff welfare got shrinked. So I want to represent my actual thing. Now, is it a right practice or wrong practice? That goes purely by the accounting permitted practices, and many of the clients have this practice. So GST will have a higher turnover what the turnover which is there in the books of accounts. Right? So there are recoveries which are there on the debit side of the P&L. One have to pay attention to. Next, on the asset side, if you notice, one of the item in the P&L which is irrelevant, which has no relevance for GST is profit or loss on sale of an asset. Whenever an asset is sold, it has no relevance for the value has no relevance. What is the relevance? The sale value has a relevance. GST is payable on the sale value. GST is not payable on the net profit that is made. So in my balance sheet, fixed assets, the gross block when I am removing and read with my net block. So in my cash flow statement, which I typically use, sale value of my fixed asset, GST is applicable on that. So your GST would be available even on the asset side also. How about liability side? Whenever you receive advance from customer, in case of service industry, for subject to the 1,000 rupees limit, you have the time of supply would trigger. And you will have to make the payment. So liability side also will carry a turnover, which is not a turnover. Okay, these are apparent and visible. What is this off the balance sheet, outside the balance sheet? Friends, we all know balance sheet will report only those where there are financial numbers. I have set up an office. Now, do I add it into my financial statements? I would only add to the extent of the assets which I have incurred in setting up the office. The new office got 10 customers more. Will it be recorded? Absolutely no. What is recorded is if I made a sale to those customers. So, but for the GST, we all know Schedule 1, which is deemed as a supply even though made without consideration. That would be deemed as a supply. I have given off the assets where input tax credit has been availed. There's a transaction between a related party, or not a related party, but a distinct party. A transaction with a related party where the value is not at arm's length. The value reported under section 15 is disregarded, and I go to the valuation rules. I look at what is the value which is specified in 28 and I'll pick that. Right. So that in the rule 28 and I'll pick that. So there are values that are coming now beyond the balance sheet, which are outside the financial statements. Even that would become part of the turnover. So before I finalize the turnover for the books, I should finalize the turnover for the GST, see the difference and assess the magnitude of difference and prepare a reconciliation statement. We all know from section 7, all the forms of supplies are there under the GST Act. So with this statement, we have covered all different forms of the supply. Having understood that, we prepare a reconciliation statement. Which is actually GSTR 9C, if I have to say, GSTR 9C, which specifically says that the one has to prepare what is the turnover in the books of accounts, what is the turnover for the purpose of GST, make all the adjustments and upward, downward adjustment and derive the turnover. Derive the turnover which is more apt for us. So that's how one freezes the turnover in the financial statements. Now, some points I would like to bring the attention to the members. First and foremost, sometimes the recoveries are taxable, not taxable. Here comes a management representation letter stating that this is our position. Now, we have various advanced rulings which have come up, which are giving a different positions. Recently in Tata Motors Limited, which they have asked for the GST liability on canteen recovery, where the advanced ruling said, okay, canteen recovery, where the employer is recovering a small portion from the employee and employer is what actually incurring. Technically, there is no supply made by the employer to employee, so there is no levy. And 4 years of GST has been passed by. Everyone have done their own method of accounting. Someone have charged at 5% on the open market value. Someone has charged at 18% on actual recovery. Someone has done nothing. Now this advanced ruling, does it mean it is a law? Again, answer is no. So it is better we take an opinion from the expert whenever there is a doubt and there is values in our material. Else, a smaller items, a management representation letter as to what is their position. Very important. Representation letter should also include the classification. As I said in the beginning, we are not an expert on the HSN classification. So the rate of tax and the HSN code adopted by them has to be certified and given by the management. It's like if you go to chapter 55, if it is a raw silk, exempt, but the silk which has some process which is done, moving to from say 54, it is moving to some chapter in 55, it is taxable. You know, there are different items which we don't know, like printing industry. I go and give an order for getting my pamphlets and everything to be printed. It is falling under chapter 49 and 5%. But advertisement material, not it's like something like a brochure, it is at 12%. But I supply him the material, I supply him the content. His job is only printing and giving back the on the material which I have given. Then it falls under chapter 99 services, you know, which is at 18%. So there is definitely, every industry has some element of iota of doubt, saying that okay, can the classification be otherwise? Now, as an auditor, they have to necessarily include as to the turnover, what is the HSN classification which has done. In fact, this segregation and reporting helps while reporting in GSTR 9 table 17, one has to report the HSN wise output details. So this MRL will serve as your additional corroborative evidence that okay, this is how I have frozen the liability. Likewise, the valuation, whenever done with the related parties, you should disregard the value which is there on the face of the invoice and redo the valuation. We will go back to the valuation rules, either rule 27, 28, 29, any of those rules, and we adopt the value based on the situation. And the time and place of supply, these are the key ingredients in any supply, get a representation. So we go as per books, presuming that the books are correct. We go purely whatever which is there in the books and we go finalize them. Then when it comes to the debit notes and credit notes, whenever there is a change in the rate of taxes, definitely the debit note and credit notes would be issued. However, first and foremost, the credit note reduces the liability and the turnover. For the financial books, definitely credit note reduces the value of the turnover value of the supply. But for GST, if I have to reduce the value of my supply, Merely issuing a credit note will not suffice. It shall necessarily pass the test of section 34. That means either the goods are returned back, or the service given is of deficiency nature, or there was an error in the invoice, or there is a discount which is originally agreed upon achieving some turnover targets it would be issued. So there is something existing to prove that it is a valid credit note. On top of it, such credit notes shall be issued before September return filing. That is, the September 21 return which is being filed on 20th October. Before that date, it has to be reported. Reported meaning it has to necessarily be filed in GSTR1. Mere putting in the books of accounts and putting in GSTR3B also not a valid credit note. This is again a mistake which people happens. Of course, when it is to be litigated, that's a different story. But technically, for you to qualify something as a credit note, it has to be there in GSTR 1. Sometimes there's a tax treatment in change in rate of taxes. You have originally paid, let's say 28%, 18%, but when you actually supplied, there was a different thing. Now the turnover is in tax and the tax amounts are changing. How appropriately the client is posting these entries in the books of accounts is very important. Sometimes it is grossed up and reported, or advance money is returned back. I have received the money, I have paid GST on it. So these adjustments are necessarily to be done before finalizing the turnover. Now, we have seen those items which are forming part of the turnover in GST, not in the P&L. But we should also look at the other aspects also. Again, whenever the taxes are paid late, there is an interest application. We now have, earlier it was a doubt whether on gross or not, but it is settled. It is only on the net. So just calculate and it needs to be provided for. This is one important slide before finalizing the accounts. Take a special items of these things which are likely to have an impact. In case of a proprietor who has a business, his business accounts are being audited. His business accounts are being audited. Now he has other incomes. He has other incomes like rental income. For the purpose of GST, rental income is also subject for levy. So you should also look at the credits that are coming into the capital account, credits into the capital account. Now rental income, again, if it is residential house used for residential dwelling, no GST. But if it is used for commercial, GST is applicable. So one has to do these reconciliations in case of the proprietor. Salary income, sometimes it is shown on the face, sometimes directly to the drawings account. It is a schedule 3 item, so it is not a GST levy. So one has to find that, okay, these are incomes, but not subject to GST. Again, in case of a partnership, if a registered partner is introducing some asset, like I have brought in my personal laptop to the firm as a capital contribution, it is a supply made by the partner, right? Because it's an asset which is on which ITC has been availed, and I am saying that I'm a registered partner. So wherever, when I say registered for GST, so it has to be treated as the supply in the hands of the partner. Likewise, when a partner is retiring, if the capital contribution is paid or discharged not by way of cash but by way of giving of assets, if the assets are given back, it is to be treated as if there is a sale made by the firm and GST is applicable as a turnover for the partnership firm. However, partner's salary, interest, remuneration is outside the scope and outside the levy. There is no levy on that activity. Then general items, a very special attention to be done. whenever there is a discount received, and we commonly use this word as financial credit note. We use this word as financial credit note. What's a financial credit note? This is credit note for the purpose of books, but not a credit note for the purpose of GST. Now, let me give you one example for the financial credit note. I have made a purchase of 1 crore. Now, supplier said that, okay, because you made so much purchase, I will give you a discount, additional turnover discount of 1 lakh rupees. So he gave me 1% discount additionally. Now this 1% which has come, I am not going to make a payment. So it is like a miscellaneous income for me. Either I would record it as miscellaneous income or I will offset with my purchase. Now this miscellaneous is income which is lying there. Do I need to offer GST on it? Answer is no. So for the purpose of GST, it is not a supply because I did not provide any supply to my vendor. I supply to my customer, not to my vendors. So there is no levy applicable. However, a careful analysis have to be done to these financial credit notes. Sometimes these credit notes take characteristic of an incentive. These credit notes take characteristic of an incentive. Like generally, whenever there is a change in the model, like in case of a car dealer, mobile dealers, whenever a new model is coming, so to augment the sales, to give incentives to the dealers, the distributor or the manufacturer, OEM manufacturer would say, look, if you sell this, I will give you say additional 1 lakh rupee, 2 lakh rupees, whatever. So these are incentives in nature. There is an element of supply, GST is applicable. So one has to be very careful while adding or deleting some items. While adding or deleting some items from the turnover. Incentive, especially cement dealers. When there is a price fluctuation, the price is offset by way of credit notes. So most of the taxpayers, this I have received from my supplier. So there is no levy applicable and they do not make the payment. So that is where the error happens. Next, Forex gains or losses. These are like a transaction in money. So neither the customer nor the supplier has any role in it. Hence, there is no element of supply. For supply to happen, there should be quid pro quo. So I agree to do something. I agree to provide a supply of goods or supply of service. I receive consideration for it. So, but I receive consideration for without a supply, or a supply without a consideration is not for levy. That is how Forex is outside the purview of GST. Profit on sale of asset we have seen, though it is an item in your income ledger, that's completely outside the scope of the GST levy, since the original asset which is being sold has to be considered. The sale value is for subject to levy, and this profit is a notional entry. It is not a real cash flow. Sometimes you would have written off some bad debts. When there is a recovery happening from these bad debts, those recoveries have no scope for levy. It would be income for the books of accounts, but it will not be an income, because when there is a bad debt happened, you have not reduced your turnover, because inability to collect from the customer will not warrant for a credit note. So the bad debts, when are raised, I did not raise a GST credit note, but I have made a recovery from this bad debt customer after a repeated follow-up. You are very much open to take it as income, but no GST applicable. So that is where that sheet which I have said about the reconciliation, that's very much important. The last items, penalty, damages, or forfeiture in nature. Now, this you might say that isn't it an expenditure? Why is it appearing here? An expenditure to one person can become an income to another person. I have purchased a machinery which is faulty in nature. Now, the supplier said because you have incurred heavy expenditure, I am willing to forego, reduce. The value of the machinery is 1 lakh. He say it's okay, you pay 90,000, 10,000 rupees. I am reducing it. Now this 10,000 rupees has now become my income. Either I would offset with the value of the machine or value of the purchase. But if it has happened in 2 accounting periods and I have already recognized it as a cost, now necessarily I have to recognize it as an income. Now these things, are they supply, not a supply? There cannot be a straight answer. It has to be seen case to case basis. Some are conditions to the contract which is not fulfilled and any money is arising out of it is not a supply. But some are considerations in the contract. So again, these are very minute difference. So something which is giving a right that is arising, which is commercial value in nature, it will have a GST element to it. So one has to again look at the quantum that is coming up and take a call whether liability exists or not. So these are the various factors that needs to be considered while finalizing the turnover. Now, turnover is finalized, then I will have to make the payment of tax. If there are errors in making payment of tax, what kind of errors? Like definitely the liability on it is considered. The errors could be it was taxable, I treated as exempt. Don't need to worry. SSC says is exempt, we have taken an MRL. It is 12%, but it is SSC is saying that no 5%. Again, don't worry, it is choice of the SSC. SSC is saying that it is 5%, so you have to accept it as 5%. Then the last error could happen is it is IGST liability, but it has been paid as CGST or SGST. So the liability could have happened interchanged in any of the method. So let's look at how do we deal with errors in tax payments. Before I go there, let me see if there are any questions in the Q&A or the chat. I see one question in the Q&A. Whether exempt income received has to be included in calculating the threshold requirement of 20 lakhs. For example, PPF interest from Satisha. Sir, whenever you receive an income and if you feel that it is exempt, I'm saying that it is exempt. If you say it is exempt income, it forms part of your turnover. 2 subsection 6 aggregate turnover includes taxable turnover and also exempt turnover. And for the purpose of computing a threshold limit for registration, the 20 lakhs, it includes both the taxable and exempt income. All right. So there are no other questions on the turnover. Okay, so moving further, let me just see in the chat box. Even the chat box is clear, no questions. Moving to the next aspect, which is errors in the payment of tax. Now, what are the errors? 2 errors we have nullified. One error, which is apparent, is let's say my right tax is CGST and SGST. What I have paid, what I have mentioned in the invoice is CGST and SGST. But in the returns, I have disclosed it as GSTR 3B and GSTR 1 as IGST. So my invoice is correct. and that is the right thing. Whatever I did in the invoice is the right thing, but I made error in the returns. Obviously, I have paid the taxes erroneously. Did I correct it? Of course, there is a circular 26 by 2017, the last circular issued in the year 2017 about GSTR 3B and 1 rectification clearly permits you to rectify this. How do I rectify it? In the next month, since I have paid IGST, in the next month I'll pay lower IGST and pay the higher C pluses. And I'll offset with the actual liability of IGST payable in that month. So since having this has been rectified, do I need to do anything in the books? Nothing to be done. Next scenario, it is rectified, but it is rectified in the subsequent financial year. Okay, it is rectified in the subsequent financial year. Like how we talk about the working notes for AS22, deferred taxes. Some differences are temporary in nature, some differences are permanent in nature. Even here, you have some, as on 31st March, the balance sheet is showing nil liability. But you know there is a C++ liability and IGST has been excess paid. So even though you net it off, the net position is same. But for the purpose of reporting it, you know that you have to adjust in the next year reporting. Somewhere you have to track. Where will you track this? The excess payment which is done IGST, I have to reduce, I have adjusted in the next year. So this will be reported in table 11 of GSTR 9. And the short payment which is done in financial year 2021 is paid in the next year. So this would be reported in table 10 of GSTR 9. So somewhere you need to have your workings that this is the turnover to be paid, this is the taxes to be paid, and these are the taxes have been paid. So much will be carried forward, so much will be adjusted. Last option, you did not make any adjustment, or you did nothing, you did not do any rectification. So how do you treat that? Again, there are two ways. Some aggressive SSEs. Anyhow, I have paid the taxes. Whatever be the taxes, I have anyhow paid. But however, if you look at section 77, it calls for payment of right taxes and claiming refund of the wrong taxes. What is the approach? How do you do it? While finalizing your GSTR 9, in table 4, you will show the right taxes and you will discharge the C plus S using DRC 03. Okay, I'm paying taxes twice. No worries. The IGST that you have paid excess, you can file a refund application and claim a refund of it. In table 9 versus table 4, you will have a difference. The tax payable in table 4 versus tax paid in table 9 will show the differences both under CGST, SGST and IGST columns, which have an explanation. One explanation for CGST, SGST is DRC 03 challan. One explanation for IGST having paid excess is a refund application that would be the proof for the officer to process your refund. Likewise, even in IGST, you will have the difference. You would have reported it in the invoice as IGST. CGST, SGST has been reported in the invoice as IGST. But in the returns, you have disclosed it correctly. It's okay. Don't need to be worried. But it has been IGST reported in the returns or also as IGST customer has availed credit as IGST. So, or generally it is not possible unless otherwise the place of supply is in his state. So you now have to take the same call as to do I need to do something or do I take this the aggressive view of deal with it in assessment. So from your perspective, you are only finalizing your turnover and the tax liability. Having finalized the turnover before closing, now since so much of the working has been done, we just need to finish and complete the last milestone. What is the last milestone? My turnover is now found out. Segregate that GST invoice. So we are completing the books of accounts from the GST perspective also. Segregate it from the books of accounts and do that reconciliation which I said, why, what is there in the books, what is there in the GST with the segregation, what is the number that you have arrived. Do that segregation activity and Having segregate found out this is my turnover, split into rate wise 5%, 12%, 18%, what is the rate wise, or 0% which is not applicable, split it into rate wise. This would also aid you in reporting into table 17 of GSTR 9 or filling up table 9 of GSTR 9C. Now these tables, don't worry, those who are equipped with filing of the GST returns, they understand. Otherwise, when you look at those tables, you'll get an idea. But these will automatically help you to fill those necessary tables. So segregate the GSTN wise and segregate the rate wise. Lastly, segregate also the category wise. How much was to B2B, B2C, everything, because the ask from the reporting is also on the category wise reporting in your GSTR 9. When you do this, this is like a triangulation report. It's like I'm uh, reconciling in method 1, reconciling in method 2, reconciling in method 3. If all these numbers are matching, then your assurance on signing the balance sheet for the turnover is very high, because this also serves as your audit working paper too, because you have analyzed your turnover in multifolds. You might think that I'm finalizing this from the GST perspective, or you can think that I'm finalizing this for building my audit working papers. In both the cases, this would serve as your audit conclusion, and your assurance of the audit goes up. The moment you have higher assurance, the risk automatically comes down, because both are inversely proportional. If there are any errors, and now that needs to be paid, and this needs to be paid beyond the September. Generally, if it is paid through returns GSTR 3B in the subsequent period, so April, May, June, July, you would have reported in GSTR 3B, and it could have been paid through input tax credit or through electronic cash ledger cash balance. But when you're paying it through GSTR 9 and 9C, here is where you need to educate and keep informed. That is where the September returns are very important. You necessarily have to pay it through DRC 03, and DRC 03 payment expects it to be paid in cash. The expectation of the department is any payment made through DRC 03 has to necessarily be paid in cash. Now there are many people who ask, okay, I'll pay it in anyhow portal will allow. I will pay using ITC ledger balance. What is the issue? Will the department ask me to pay it again? Of course no, because taxes have been paid. So section 49 permits you the manner of the adjustments read with the rule 85. You can use like electronic cash ledger, credit ledger balances have been given to use the tax payments. Now, what will the department do is the question. But department can levy a penalty, minimum penalty of 15%, stating that this is like a fraud. You are not supposed to use ITC. You have used ITC. Please pay a penalty of 15%. There are all chances that the department would come back. So please be aware of this and make, of course, litigate. How is it genuine litigatable? Everything we have a different options, including we have seen as recent as in VKC footwear Gujarat High Court view. Then we had which said that okay, input services can be claimed. Madras High Court in a different case said no. Both combined under Supreme Court said okay, fine. Madras High Court views right, but at the High Court level views also can be different. So what I'm trying to say is whatever we are doing at a compliance, not necessary under litigation it would hold good, because it is a view, it's a stand taken by the SSE. That is where always the benefit of doubt, if the SSE is willing to fight for it, it is his books, his accounts, he can present it however he wants. I don't need to do an additional qualification as long as there is no demand on it arises. With this we have completed the turnover and the liability. We are moving to the next part, fourth part of the discussion, which is freezing on input tax credit. Any questions to anyone at this point? Okay, to input tax credit. So from the audit workings, what you should be asking the SSE or what you should be expecting from the SSE is to segregate all his expenditure, both revenue and capital, into two categories. Those expenditures with GST, those expenditure without GST. Again, with GST, how much is eligible, how much is ineligible, what are the line items which are eligible, what are the line items which are not eligible. And those without GST, very important, more care has to be looked into wherever there is no GST. Why? Because why there is no GST? Have you purchased from a dealer who is not registered? Then is 9(4) applicable? Of course, thankfully it is applicable only in case of works contract and real estate scenarios. Okay, you have purchased from registered dealer. Why did he not levy? Is he a composition dealer or is it an exempted product? If none of that comes in, then you need to see whether I, as a buyer, should I pay under reverse charge? Very important, because there is a liability that is going to arise. As an auditor, we have to qualify and quantify that expenditure and ask the client to provide for it. We never know that the reverse charge is going to become a bigger litigation, because 16 subsection 4, where the condition to avail the input tax credit within September is applicable for reverse charge also. There is another school of thought which says no, it's not applicable. But however, at the time of complying with the law, it has to be read and looked into as if it is applicable, and the reverse charge needs to be paid within the specified time, even though it is a revenue neutral. Those where there is eligible, where there are line items with GST is there, make as input tax credit register, because even section 35 warrants to have an input tax credit register. And today everyone uses some software, some technology to automate and reconcile the credits. So get an input tax credit register be built upon. And when they have claimed a credit, again, please be aware whether they are genuine. I'm not going to look at explain you completely about input tax credit, but those basic conditions which is given in 16 subsection 2, read with those three provisos, that you have an invoice, you have received the goods, you have made the payment to the supplier within 180 days, and the supplier has paid the taxes to the government. You have included it in your GSTR 3B, and this credit is not blocked under section 17. If there are credits which are common, you have reversed them under rule 42. All these things you have to look into. And the additional thing which is there under rule 36 sub rule 4, where the quantum of the credits that can be availed is only the 5%. So you got to pay attention to all of this. An ineligible credit, how do I look at it? We have anyhow prepared a ledger input tax credit register, so which is there expenditure wise, vendor wise, whether just look at whether the expenditures are fitting into any of this, both capital and revenue, which has been blocked under 17 subsection 5, specifically whether it is on capital, food and beverages, or some of the goods which have been lost, or it is purchases on account of beauty treatment or employee life insurance. All these things, just make this segregation and see if anything of that, these credits are not eligible. I'm not getting into detail of it, but that has to be looked into. And as I said, the 16 subsection 4 sets a time limit that it has to be availed by this date. So the line items which are there as on 31st March for the financial year 2021, you have to necessarily look into and reconcile all those lines, which are there between books and GSTR 3B. And wherever if something lines which are excess, so you have to ask. So you have to do books versus 3B, 3B versus 2A. If a line item which is there in 2A and not in books, you have to see if there is any expenditure which is not provided for. Or if there is a line item which is there in books not in 2A, do at that test, how does the SSE wants to claim it and justify this? because section 155 of the act is very clear. Those who are claiming the credits, they have onus to prove that those the credits are genuine and fulfilling all the conditions. So one has to ask for it. And there are case laws which are favoring wherever the credits are not, line items not in 2A. Not getting into those subject, but if something like that, the necessary the ownership is on the SSE to justify for it. Next, whenever there are import of goods, there is a bill of entry which is filed. Thankfully, those line items are also coming in 2A. If it is not there, check for it if there is any error made in the bill of entry. Common error that happens in the bill of entry, in case it's a courier bill of entry, the agency reports in that bill of entry multiple GST numbers, look at for that. Or there are multiple GSTNs. So a Delhi office has placed the goods have come to Calcutta port, the Calcutta GST number, the West Bengal GST number is mentioned and the goods have been cleared. So on the bill of entry, West Bengal GST number is there, but the books have been, expenditure is there in the Delhi, the books, and the ITC has been claimed by the Delhi. Now these kind of issues will come into the litigation. Pay attention, and whenever there is a item there in 2A not in books, or there in books not in 2A, special attention has to be done. These input tax credit we also reconcile and give for the purpose of GSTR 9C. Something like a bank reconciliation in table 12 of 9C, we report it, and after reconciling, we segregate that into input services and capital goods. This is required for the purpose of GSTR 9. And even though there is a relaxation by way of circular 50, by way of notification 56/2019, where they have said that okay, certain things can be excluded, optional. I would suggest that everyone does this reconciliation to the maximum possible. In a simple way, if I have to say GSTR 2A, when I can get vendor wise, I can classify the vendors into various nature of expenditure. Basis the nature of expenditure, I can segregate whether it is input or input services or capital goods. A simple pivot table will also help. So if a client has not reversed any common credit owing to rule 42 and 43, there is an expenditure which is going to come up in the next financial period, owing to which there is a distortion in the profits. So it is better that has been recorded, computed, and provided. If someone is claiming CSR expenditure, some input tax credit on CSR offsets with the expenditure, some avail for that. As long as there is an opinion backing by it, they can go with it. There are again multiple opinions under the law. So I'm not saying that it is eligible, not eligible, but as when you're finalizing, be aware of it. And lastly, make sure that you build your input tax credit register properly. We know we have multiple cases where when the SSC has approached the department saying that I made an error, they have the judgments have come up saying that allow him to rectify. So in Sandaikem, the Madras High Court said, let the GSTR 3 be rectified. So we have circular 26 which is giving us guidelines as to how it has to be rectified. But however, as long as the credit is done, so should be okay. Just to summarize on input tax credit, if it is used for business, eligible; used for export, eligible; used for exempt or personal purpose, not eligible. Anything is common, apply rule 42 and 43. So this is a due care one has to take while finalizing the input tax credit. So we have seen the turnover, we have seen the liability and the input tax credit. Certain things on reconciliation for input tax credit and key action points. Reverse, including the reverse charge. Let me talk about the reverse charge aspect of it. Firstly, when you are looking at the line items in GSTR 2A, the following things which are appearing on the screen are to be ignored. Wherever the supplier filing status is no, ignore it. If reverse charge is mentioned as yes, ignore it because it is not a credit, it is a liability. if the documents amended, there's a field for is amended. If it is amended as yes, that means there is one more line item for it. You should take that and you should ignore this. If the place of supply, like our registration certificate starts with 29, so the place of supply should be Karnataka, which is 29. So if the LOR and POS, location of recipient and place of supply, is not same state, it is not eligible. So ignore that, and then you take whether you want to finalize it or not. Then reconcile that with the books of accounts. How do I reconcile? What has been availed in this year, what has been availed in the next year, what has been reversed in the next year. Do a simple reconciliation like bank reconciliation and take it. So with this, we have completed the input tax credit. Let's move to the another item of input tax credit, which is not forward charge, but is a reverse charge. Reverse charge, as I said, very important, because tomorrow when it has to be paid, it will not be a revenue neutral. It will only become cost, and you will pay the taxes as a liability. No input tax credit would be allowed. What about reverse charge? Firstly, we should understand reverse charge is 9394. Unregistered purchases 94 is not applicable to many, except that real estate developers. It is not applicable to many. Only 93. 93, there are notified various services. Notification 13/2017 updated time to time. Various services are there. I have highlighted in the blue color whatever which is more applicable to us. This is more common. GTA, legal services, sponsorship services, payments to the central government, state government, or director services, security services, renting of motor vehicle. Whenever these expenditure in nature, ask the audit member to pay special attention, quantify that, and most of this are at 5%, sorry, at 18%, except the GTA, which is at 5%. Just ask them to see how much has been paid, whether it is paid fully or not. Goods, very unlikely. There are very few goods which have been specified. What you have to look for is there is a liability that needs to be paid, which will be reported in table 4G of GSTR 9, and the input tax credit for against which will be availed. It will be availed in 6C or 6D, so either unregistered or unregistered. So look for that, and both have to match. So the input tax credit availed should be lower than or equal to the liability that is paid, and the liability that is being paid, look for in the table in the GSTR 2A, where the is reverse charge as yes, mark those and see at least so much liability has been paid or not. And the credit availed should definitely be compared with whatever those line items which are there. So it is very important that we do this comparison. A quick, the threshold limit for the GSTR 9 has been relaxed, and we know up to 2 crores 9 need not be paid, 9 need not be filed, and up to 5 crores 9C need not be filed. And certain adjustments that we do in GSTR 9C is, if something is paid in the next year, we take it to table 10 and table 11. So as you are finalizing your books of accounts, prepare your the GSTR 9 and 9C and see whether those are matching with the audit adjustment entries. There are certain adjustments. So I have completed my explanation on presentation, turnover, ITC. The last part of today's session is the adjustment entries that needs to be posted into the books of accounts. You know, in audit, we all look at external evidence. The external evidence is very important. So we should also suggest and advise the client to maintain the external evidences. The external evidences, the evidences which will help the audit, which will aid the auditor as the values in the financial statements are correct. First thing is on the liability. Whenever I make a sale, I debit the party with full value. Let's say I'll debit with 118. I credit my sales income 100 rupees, and I credit my output liability, output CGST 9 rupees, output SGST 9 rupees, or output IGST 18 rupees. So there is a liability ledger that is being created. Basis the values which are there in GSTR 3B. Basis the values which are there in GSTR 3B. I create a control entry. I debit my output CGST, SGST, IGST based on the liability I have disclosed in my GSTR 3B, table 3 of GSTR 3B, and credit electronic liability ledger. I create a new ledger called electronic liability ledger. As I record this, what are the things that's happening? The moment I do this, ideally output CGST ledger should be 0. In spite of posting an entry, if my output CGST ledger has a debit balance, that means I have reported more liability in GSTR 3B than what is there in the books. Vice versa, if there is a credit balance, that means I have missed out reporting some liability in GSTR 3B which is there in the books of accounts. It will help you that you need to pay it in the next period, like whatever which is to be reported in table 10 and 11 of GSTR 9. So this will aid you in carrying forward and reconciling those balances. You would do this both for forward charge liability and reverse charge liability, because in reverse charge it's a contra. You artificially create a liability and create a asset. Like your liability ledger, you also advise in posting the input tax credit. So whenever I'm recording my input tax credit, as I said, post both the entries for the eligible, ineligible. So that you can verify it with GSTR 2A. So having posted that, now I will debit electronic credit ledger. Electronic credit ledger, I will debit and credit my input CGST, SGST, IGST. Wherever it is not eligible, I will charge it off to the P&L to the respective head of account. If you are wondering what is T1, T2, T3, this is as per the rule 42, something pertaining to the non-business personally used T1, used for exempted is T2, part of 17 subsection 5 is T3. So these are ineligible credit. You will be doing this for regular credits, reverse charge credit, you will be doing for import of goods also. So this way what is happening, the biggest chunk electronic credit ledger, which is the government or the contra books of accounts, that is matching. So you have a satisfaction to sign the financial statements to the extent of the electronic credit ledger balances. If there are balances is input CGST, SGST, IGST, the client has a necessary method of answering you, explaining why at all there are balance, maybe debit, credit, but still any balance, it needs to be explained. Rather than having a general balance, which we would have said that owing to the purchases, now it is more specific. He has a ownership to explain. And obviously, whenever we are making a payment, we just debit the electronic cash ledger and credit the bank. So basis my PMT06, you can cross verify the challans and finalize the books of accounts. Yes, these have been paid to these GSTNs only. As you offset liability basis table 6.1 in GSTR 3B, you will debit your electronic liability ledger and credit your electronic cash or credit ledger. So with this, you have ensured your books of accounts are matching with the electronic registers, and if there are any balances beyond this, they have to necessarily be explained and confirmed by the SSE. These accounting entries generally most do not suggest. I would personally recommend get these entries posted so that you have a clarity, and use bill references appropriately so that you get even more detailed analysis of the balances that are lying. So friends, we have seen the last part of the discussion, which is on the adjustments to be done in the books of accounts. Any questions to anyone so far? There's a question from Shankar. Is RCM applicable on ROC fees paid by the company directly or paid by the professional on behalf of the client? Now, wherever the services are provided by the government which are in the nature of the statutory obligation. Like I'm incorporating a company, I necessarily have to pay. So certain fees are exempt. So any license fee which is paid is exempt. So there is something which is a fee which is to be paid is exempt. But if something is paid for providing service, ROC also provides additional services, document search and other things. Those are a service which has been obtained. It has to be necessarily be paid under reverse charge. Then question from Raviraj: if there is a failure to pay RCM, which is detected after 30th September for the previous year, then can ITC still be claimed? Raviraj, the answer is not an 100% affirmative. There are all the chances by the department to be saying that you have not availed it in the due time. And in my personal view, 16 subsection 4 would be applicable to it, and availing input tax credit is doubtful. Okay. Before I conclude the session, I thought I'll give you some information on the the summary points that please finalize what are all the differences that are carried forward to the next year. As on 31st March, what are the effects of 21-22 in the 2021 financial GSTR 99C? Taxes paid in the subsequent year, credits availed in the subsequent year, credits reversed in the subsequent year, not paid to the vendor, so I disallowed the input tax credit, which will be re-availed in the subsequent year. Have these working papers in your financials along with it. And there are some relaxations which have come by the government by way of 56/2019, saying that for the year they have anyhow the same GSTR 9, there's a label change. So you have these adjustments that happen in GSTR 1, upward, downward adjustment. You don't need to report it upward and downward. You can net it off. Debit note, credit notes, you can net it off. Both taxable and exempt, you can net it off. Input tax credit necessary to be segregated between input services and capital goods. So the government said that you can, the government said only the capital has to be reported, others can be ignored. The input tax credit availed and adjusted in the subsequent period can be ignored. Table part, the last part, part 6, is made optional. However, if your workings are perfect, you don't need exemption to, you don't need a reason to have exemption of all this. Everything can be happily be filled in GSTR 9 and 9C. Friends, with this we have come to the end of today's discussion on what are the points you have to consider before you finalize your accounts, both on the turnover, tax liability, input tax credit, and presentation. So house is open for any questions. If you have any questions, please put it.
There are two questions in Q&A, Mr. Venu.
Yes, sir.
You want me to read? Whether exempt income received has to be included in calculating threshold registration requirement, which is 20 lakhs. For example, PPF interest.
Right. So this question during the session I have taken, yes, the moment it is exempt income, it has to be considered for the purpose of threshold.
Okay. The example he gave is PPF interest, whether that needs to be included.
Right. So now technically, interests are of two nature. I didn't want to specifically look for PPF interest. See, you do not make any investment for earning interest, then there is no supply. Interest earned on fixed deposit is necessarily is a supply, and it is an exempt income. But an interest income which is earned on, say, SB account or interest received on IT refund, you are not parking funds there to avail any income on the interest. They are not an exempt income. They are not forming part of the turnover. So there is no supply. So you have to segregate the incomes, whether they are a supply or whether they are no supply. So that SB or IT refund or the PPF interest, in my view, is no supply, cannot be included in the turnover. But you have earned some interest income which is exempt, because the question had a multifold the facets. So if it is income which is exempt, then you have to include in the threshold calculation.
The next question is RCM applicable on ROC fees paid by company directly or paid by professional on behalf of client?
Again, so this we have also discussed. So whatever is the necessary fees which is prescribed in the law and which acts in the nature of the licenses. So I necessarily, if I have to carry on some business in India, I have to comply with certain laws, and those laws demand certain fees to be paid to be for me to be active. All those are exempt in nature. You don't need to pay any reverse charge liability. But beyond that, if I am paying something, so for availing some services, so I have done a search report, I have downloaded some documents by paying the ROCP, those cases you will be paying under reverse charge.
Yeah, that's all the question, and people are asking for the PPT. I request you to please share with the Bangalore branch. So we will upload in the website which you can access it there.
Absolutely.
So all the participants can download from there.
Sure.
So that's all the questions we have, you have answered in detail. Thank you very much. We had an excellent session, and this is most required one at this point of time for people are finalizing the accounts, and they can consider all the points which you have discussed in detail. Thank you very much. I think Divya is not there. I'll do that. Thank you very much, Venu, for a wonderful session. The session was excellent. I was participating in that throughout. Thank you very much. And the participants were also the reason for this program. Your active participation made this program a successful one. Thank you very much. We will upload the PPT in the website. You can go through later also. Even the YouTube also available. You and inform this to your friends, those who have not attended today. Thank you very much.
Thank you.
Good night.
Good night.
Thank you.